What is trading? How does trading work? What are the different types of markets? How is trading different from investing? What are the different financial instruments? How do these instruments move? What factors influence price? How do I read a market? These are some questions that I will be answering throughout the following section material, which you can expect to understand after the completion of this chapter. While I cannot guarantee the absorption of any information that I communicate, I hope that you will not only find the answers to these questions, but develop a deep enough understanding to where you can actually apply it. It is important to remember that knowledge means nothing unless it can be capitalized on, and this is ultimately the intention that all involved parties must agree to. That being said, it is of my utmost importance within this program to provide genuine and authentic knowledge and how to properly implement these into the real world. Before we begin, I want to take this opportunity to thank you for choosing order flow only among the expansive resources available to you. Whether you find that my teaching style and formatting is of appeal, or maybe find it to be the exact opposite, your involvement with us is massively important. It is your trust and support that acts as the driving force behind our efforts to provide material of the highest quality. And at the end of the day, I am here to educate those who are willing to learn. And if I can help just one individual find success within this field, it really would make it all worth it. So once again, thank you so much for being a part of our community, and we look forward to helping you grow into the trader that you aspire to be. Welcome to Order Flow Only. To provide some structure to this chapter on fundamentals, the material has been divided into 6 sections, which are then separated further into individual lessons. You will notice these divisions within the program have been done for the primary reason to allow you to review specific sections that you may find confusing or need clarity on. Within each lesson, we have also provided a feedback form for you to express your thoughts and opinions on the material, which can help us refine and improve on our program as a whole. There's a chance that some topics or pieces of information may have been overlooked, which is why we encourage your feedback. That being said, let's look into the different subsections of material within this chapter. Every chapter will begin with an introduction on material expectations, along with some basic terminology which is imperative when moving forward. This will then be followed by an analysis on the different financial markets, including the advantages and disadvantages between them. Our third section will cover different trading styles, which is followed by an in-depth analysis on the differences between a trader and an investor, both of which are fundamentally different. Our fifth section will review types of orders. We will then finish off this chapter on the different types of market participants within a given market and the different controls and influences they have on a market. Now, if these topics do not spark any questions, consider looking into our second chapter, which takes on a comprehensive examination of 7 different styles of market analysis, all of which are separated among beginner, intermediate, and advanced tiers. If you do find this interesting, you can learn more by visiting our page at orderflowonly.com. I would also like to note that this second chapter regarding market analysis does come at a premium, as opposed to this chapter, which is free of any financial obligation. That is why we decided to make this first chapter free of charge, in order for you to gain a better understanding of the content, my teaching style, and whether or not you find this beneficial. I hope that by the end of this chapter, you can figure this out for yourself before making any financial commitment to anything. With that being said, let's begin with some foundational terms that I will be using throughout this chapter's material. The first term, which is used very frequently within this industry, is price action. Price action can be defined as the movement of price over time, or the action of price. Price action forms the basis of technical analysis, which can include chart patterns or indicators. Typically, price action can be visualized or charted using the candlestick chart, but there are numerous other variations of charting which do possess their own costs and benefits. For now, all you have to recognize is that a green bar means price is rising, while a red bar means price is falling. These bars typically have wicks, which are lines on the upper and lower portions. I don't have that included for simplicity reasons, but we will be going over the technicalities of a candlestick chart in the future. I also quickly want to preface that my primary use of charting does involve the colors black and blue. This is simply what I like to use, but it is not inherently different from any other color. The second term, which you may have heard of outside of the trading space, is volatility. Volatility is defined as the frequency and magnitude of price action in the relevant context. Higher volatility implies that there are stronger, faster, and more aggressive moves within price action, while lower volatility describes smoother, slower, and of course passive forms of price action. Now, generally speaking, low volatility markets are safer, while higher volatility markets involve more risk. When determining the volatility within a given market, we can look at its standard deviation of change in price. We can also look at the average changes in price and the market cap of that market. The market cap, or the market capitalization of a stock, is the total valuation of its shares. This can help us determine volatility, as greater market value implies greater difficulty in manipulation. Now, manipulation is a bit of a more intermediate/advanced term, so we don't have to go over that just yet, but understand that the market cap can identify the volatility of that given underlying asset. The third term I would like to discuss is aggression, which can be used to describe the strength, size, or quantity of buyers and sellers. Aggression can typically be found at key levels of interest among the participants within a given market. The more aggression on the buy side or sell side, the stronger the momentum, which ultimately increases volatility. The less aggression, the weaker the momentum, which often results in less price movement. You can imagine aggression as how aggressive the buyers or sellers are in a given market. This can be used when identifying where price is trending or anticipating on trending towards. A market where sellers are very aggressive would expect the market to move to the downside, while a market with weak selling aggression would imply that the market might go up. Another term that is critical for you to understand is capital. Capital can be described as assets which are typically used to buy or sell other assets or securities. Now, capital in the context of the financial markets will typically include cash or some form of online cash. This is quite a simple and possibly obvious term, but it is used often to define the amount of cash that a trader has. The diagram you can see below displays two individuals who have highlighted their trading capital above their heads. The person on the left has just begun trading and has a $5,000 account which he can trade with. A professional and more experienced broker on the right has $150,000 in capital to trade with. You can otherwise identify capital as the account value or portfolio of the trader. In close association with capital, margin is the capital that is borrowed from a broker to use alongside their personal capital. In other words, margin is borrowed capital or borrowed money. The visual below shows that our beginner trader has borrowed $10,000 from our broker on the right. We can now see that the person on the left now has $15,000 of capital as opposed to their original $5,000, while the broker has now reduced his capital to $140,000. A phrase, so to speak, you may hear in the trading community is trading on margin, which essentially means that they are trading on borrowed capital. I would like to note that borrowed money acts the exact same as personal money, except there can be major consequence if the borrowed money is not paid back. As of right now, I will not be getting into these consequences, but if you are inexperienced in regards to trading, it is best you avoid trading on margin altogether until you are highly knowledgeable and experienced within the business. Our final term, which you will hear quite often, is liquidity. Liquidity is the amount or quantity of buying or selling that occurs within a given market. Similar to volatility, liquidity can change among different markets, which limits your freedom. Liquidity can also change among different times within the markets. Now, a great example of liquidity can be found when looking at the price action of a major index, such as the S&P 500, or a large stock such as Apple. If you search up one of these markets, you will find that the liquidity or the quantity of participants is much greater during the typical trading hours as opposed to the off hours. In Pacific Standard Time, the market is open from 6:30 a.m. to 1 p.m. In Eastern Standard Time, the market is open from 9:30 a.m. to 4 p.m. Outside of these hours, you will see that price action becomes extremely passive and lacks volatility. It also lacks a lot of volume, otherwise known as liquidity. This can make it difficult to catch moves and find entries and exits of your choice. This is because when there are less people participating or involved in the markets, there is essentially less opportunity for you to also be involved. So that wraps up all the terms I wanted to review with you guys in detail. While there is likely to be other terms mentioned throughout the material that you are unfamiliar with, these are the most critical for your understanding. If there is anything you would like clarification on specifically, please contact us and we will respond as best we can. Now let's move on to our second section, financial markets.